It's funny. Usually when we talk about a major technology company, there's a really clear picture that forms in your head almost immediately, like a distinct brand identity.
Oh, absolutely. Like it's baked into your brain.
Right. So like when you hear the word Apple, you immediately think of, the sleek iPhone in your pocket or the Mac sitting on your desk.
Yeah, or if someone says Tesla, you just instantly picture an electric car quietly accelerating down the highway.
Exactly. The association is just absolute. But then, you say them Motorola.
Oh, man.
Yeah. And I guarantee you, if you were to just walk down the street today and ask 100 people what pops into their head when they hear Motorola, 99 of them are going to smile, get a little nostalgic, and start talking about flipping open a silver Raise phone.
Back in what, 2004?
Yeah, 2004. They think of that immensely satisfying physical snap when you ended a call by just slamming the phone shut.
Which was the best feeling. It really is a remarkably powerful cultural memory. The Razor was, a defining piece of consumer technology for a whole generation.
Yeah, it totally was.
But from a modern investing standpoint, and really a technological standpoint, it's an incredibly outdated memory. It's the absolute definition of a perceptual blind spot in the market right now.
A massive blind spot. Because, while the general public still associates the name with those early 2000s consumer electronics, the reality of what this company is doing today is just entirely different. The consumer phone division was spun off and sold away a long time ago.
Completely gone.
What remains and what we are looking at today is a company that has quietly and methodically transformed into this massive AI-powered public safety and defense juggernaut.
Juggernaut is the right word. And we aren't just talking about a participant in that space. We're looking at a deeply entrenched dominant force. We're talking about a highly complex ecosystem of mission-critical communications, video security, command center software, and increasingly, and this is huge tactical defense technology that operates on a truly global scale.
Which is wild when you think about the flip phone roots.
It is. It's a company operating in environments where the technology simply cannot fail. Ever.
Which brings us to our mission for today's deep dive. So welcome in. The goal today is to break down the Motorola Solutions, that's ticker symbol MSI, their first quarter 2026 earnings call. And we're doing it specifically for you, the listener.
Whether you're a retail investor or, a tech enthusiast or just someone trying to understand where public safety meets artificial intelligence.
Exactly. We are going to cut through the Wall Street jargon, look way past the basic headlines, and deliver a clear, opinionated, and highly actionable look at whether this stock actually belongs in your portfolio.
And we really have our work cut out for us this quarter.
Oh, big time.
Because there is a tremendous amount of jargon and just complex financial machinery to decode here. We're going to be looking at everything from complicated acquisition earnouts to supply chain headwinds.
And most importantly, how they are literally rewiring the physical and digital workflows of first responders by embedding AI.
Right.
So let's start where we always have to start, the headline numbers. And looking at the top line data right out of the gate, it paints a picture of a company operating with serious momentum. Q1 revenue hit an all-time record for the company.
Yeah, all-time record.
Yeah, it came in up 7% year over year, which handily beat management's own internal guidance.
And that is a critical data point for you to understand. A 7% top-line growth for a company of this massive size, operating primarily in public safety, municipal, and government sectors.
Which are famously slow, right?
Oh, notoriously slow-moving spaces. So 7% is a very strong signal. It shows that demand isn't just steady. It's actively accelerating despite all the broader macroeconomic uncertainty out there.
Right. And so then you naturally want to look at the bottom line to see if that revenue actually translated into profit.
Yeah.
And initially, it looks great. Non-GAAP earnings per share, or EPS, came in at $3.37.
Nice bump.
Yeah, that's up 6% year over year from $3.18. So you see record revenue, you see non-GAAP earnings beating expectations, and your initial reaction is to think, incredible quarter, the engine is humming.
And there's a big but here.
But this is exactly why you cannot just blindly trade on automated news feeds or push notifications. Because if you look at their GAAP EPS, that's the generally accepted accounting principles number, which is the official, strictly regulated metric. It was actually down.
Yeah, it dropped.
It dropped from $2.53 a year ago to $2.18 this quarter. So to the untrained eye, or an algorithm just scraping the GAAP numbers, it looks like their earnings shrank significantly.
Right, and this discrepancy between GAAP and non-GAAP numbers is, it's one of the most common traps for retail investors.
It catches people all the time.
It really does. And this specific quarter for Motorola Solutions is like the perfect case study to unpack how Wall Street accounting actually works. The non-GAAP number reflects the core everyday operations of the business, the stuff that keeps the lights on.
The actual underlying business health.
Exactly. The GAAP number, however, is forced to include every single financial event. One-time charges, restructurings, acquisitions, all of it gets shoved in there.
So I want to dig into that specific drop to $2.18 because I know it was heavily driven by this massive $75 million non-cash charge.
Yes, a very interesting charge.
Right. So I saw this was tied to a recent acquisition they made, a company called Sylvus. Now, my initial thought when I see a massive charge right after an acquisition is that they found a skeleton in the closet.
Yeah.
Right. Or they're having to write down the value of the asset.
Which happens a lot in M&A.
It does. But digging into the call, this is actually tied to an earnout. And I want to make sure we truly understand the mechanics here because it's fascinating.
Absolutely. So in the world of corporate mergers and acquisitions, when a massive entity like Motorola buys a smaller, super high growth company like Sylvus, they rarely just write a single massive check up front for the whole thing.
It's just too risky.
Way too risky. What if the product fails? So instead, they structure the deal with an earnout. It's essentially a performance-based contract.
Okay.
Motorola says to the founders of Sylvus, look, we will pay you an initial sum of money today to acquire the business. However, if your technology is truly as revolutionary as you claim and you hit these highly specific, really aggressive revenue and growth targets over the next few years, well, we will pay you an additional predetermined bonus amount later.
So it's basically a risk mitigation strategy for Motorola.
Precisely.
Like if the acquired company turns out to be a dud, Motorola didn't overpay. But if it crushes it, the founders get their full valuation. So this $75 million charge, is this essentially Motorola's accountants looking at the books and realizing, Sylvus is actually hitting all those crazy targets we set?
I mean, is probably the wrong way to frame it emotionally, but mechanically, yes. Sylvus is not just hitting those targets. They are absolutely blowing past them faster than anyone on Motorola's modeling team anticipated.
Wow.
Yes, Sylvus is accelerating so rapidly that under strict GAAP rules, Motorola is required to officially record that anticipated bonus payout as an expense right now.
Because the probability of paying the maximum earnout is basically a sure thing at this point.
Exactly. It's near certain. So that $75 million non-cash charge taking a bite out of the GAAP earnings is literally the financial manifestation of Sylvus succeeding way too quickly.
Okay, so on paper, it artificially drags down the official profit number for the quarter.
Yeah.
But in reality, you're translating this as a massive win. Like it's the best possible problem a CFO could have.
Without a doubt. I mean, you never want to overpay for an asset, but if you're forced to pay out the absolute maximum earnout on an accelerated timeline, it means you bought an absolute rocket ship of a business.
Right.
It means the integration is working, the market demand is explosive, and the asset is generating immense value. So when we strip away that strict accounting technicality and look at the core operational profitability, those non-GAAP numbers, the picture of Motorola Solutions is incredibly bright.
And speaking of that core profitability, the margin story here is what really caught my eye.
Oh, the margins are beautiful.
Because we can talk about top-line revenue all day long, but, if it costs you $1.10 to make a dollar, revenue doesn't matter. You're losing money.
Right. Growth without margins is just a quick way to go bankrupt.
Exactly. But Motorola's non-GAAP operating margins actually expanded by 50 basis points, bringing them up to 28.8%.
And for anyone listening who might not be familiar, a basis point is just 1/100th of a percentage point. So 50 basis points is an expansion of 0.5%.
Which might sound totally negligible in everyday terms.
Right, like a rounding error on your grocery bill. But when you apply a 0.5% margin expansion to billions of dollars in enterprise revenue,
it drops massive amounts of pure cash straight to the bottom line.
Exactly. It's huge.
And what stands out to me isn't just the 50 basis points, it's the consistency. The trend line is just undeniable. I mean, this marks the 5th consecutive quarter of year-over-year operating margin expansion. 5 quarters in a row of becoming more profitable on every single dollar earned.
It demonstrates just exceptional operational discipline by the management team. It really proves that even as they are growing their top-line revenue and, integrating these acquisitions like Sylvus and expanding globally, they are not bloviating their expense structure to achieve that growth.
They're scaling smartly.
Very smartly. It's a very clear indicator that they have significant pricing power and extreme efficiency in their supply chain operations, which we definitely need to explore that further.
We do, and that brings us to the operational reality of how they are actually making this money. Because looking at their business structure, it feels less like a traditional tech pivot and more like, the razor and blades business model.
Classic.
Right, but with literal life or death stakes. Because they have two main segments. First, products and systems integration, which is the hardware side. The physical walkie-talkies, the body cameras, the dispatch consoles.
The razors.
The razors. And second, software and services. So they sell you the physical hardware at a reasonable margin, but the real business is the software subscription that prevents that radio from ever dropping a signal. It's an ecosystem built on consequence rather than convenience.
That is a phenomenal way to frame it. The strategic pivot from being hardware-centric to being software and services-centric, that is the holy grail for enterprise technology company.
Because of the recurring revenue.
Exactly. It smooths out the lumpiness of revenue, it makes customers incredibly sticky, and it generally commands a much higher valuation multiple from the broader market because Wall Street just loves predictable recurring revenue.
But I have to push back here because this is where a skeptical investor needs to really look closely at the data.
Okay, let's hear it.
I am looking at the numbers for the products and systems integration segment again, the hardware side. It only grew by 1% this quarter. Now, if the hardware is the foundation of this entire ecosystem, the Trojan horse that gets them into the police precinct or the fire station in the first place, if that core hardware business only grew 1%, doesn't that suggest the foundation of the house is stalling out?
It is the exact right question to ask. I mean, on a superficial level, 1% growth looks anemic, almost concerning. But context and financial analysis is everything, right? We have to look at what that 1% growth is being compared against.
The year-over-year comparables.
Precisely. You have to rewind and remember the global supply chain crisis we recently navigated.
Oh, right.
During the pandemic and its immediate aftermath, global semiconductor supply just dried up entirely. The bullwhip effect in the supply chain was severe. So Motorola, like pretty much every other hardware manufacturer on Earth, accumulated this massive backlog of hardware orders.
Because municipalities were placing orders for radios and cameras, but Motorola physically could not fulfill them.
Right, they just couldn't get the internal chips, so they were sitting on this mountain of unfulfilled promises. Then, last year, that supply chain finally unclogged.
The floodgates opened.
Exactly. The semiconductor supply normalized, the ships finally arrived in port, and suddenly, Motorola was able to fulfill all those pent-up, backlogged orders in a very short window. As a result, in Q1 of last year, they posted massive, completely anomalous double-digit hardware growth.
It was a historic bottleneck clearing all at once.
Right. It wasn't normal demand. It was 2 years of demand shoved into one quarter.
Ah, I see. So this quarter's 1% growth isn't actually a sign of stalling normalized demand.
Yeah.
It's a sign that they are trying to beat a virtually unbeatable, artificially inflated quarter from last year.
Exactly. The fact that they managed to eke out any growth, even just 1% over a period that saw double-digit pandemic recovery growth, is actually a quiet victory.
Yeah.
It means the baseline demand is incredibly strong. But if you really want to gauge the true underlying health of their hardware demand, you don't look at the revenue they recognize this quarter.
Where do you look?
You have to look at the backlog.
The backlog. Yeah, this came up constantly on the earnings call. And it makes sense because backlog represents signed contracts.
Right.
It is guaranteed money where the customer has said, yes, the purchase order is signed, but because the product hasn't been delivered or the software hasn't been activated yet, they legally cannot recognize it as revenue on the income statement.
Right. It's their financial reservoir.
Yeah.
And what did that backlog look like? Well, Q1 orders were up a staggering 38%.
38%.
Think about that discrepancy. While recognized revenue for hardware was up 1%, the actual new orders placed by customers grew by 38%. This massive influx of demand pushed their total ending backlog to an all-time record of $15.7 billion.
That is up 11% year over year. $15.7 billion sitting in the vault, waiting to be turned into revenue. That is an astronomical number.
It is, and beyond the sheer size, you have to consider the quality of that backlog. It is incredibly defensive.
What do you mean by defensive?
Well, when you have $15.7 billion in government, municipal, and public safety contracts, you are heavily insulated from short-term macroeconomic shocks. Like, if consumer spending drops tomorrow, or if inflation spikes, a retail clothing company panics.
Right, because people stop buying jeans.
Exactly.
Okay.
A consumer electronics company panics because people delay buying a new TV. But Motorola doesn't panic because a city government does not cancel a critical 911 dispatch upgrade just because the Federal Reserve raised interest rates. That revenue is locked in. It's mission critical.
That insulation is a massive advantage for them. So if the hardware foundation is solid and growing in the backlog, let's look at the segment standouts that are actually driving the revenue growth today. Going back to that razor and blades analogy, the software and services segment grew a massive 18%.
18% growth on recurring revenue streams is phenomenal. It basically validates the entire corporate thesis. Once these agencies buy the physical hardware, they are aggressively adopting the software subscriptions that make that hardware smarter and more efficient.
And within that software growth, two specific technological areas really stood out to me. Command center tech shot up 27%, and video was up 16%.
Both huge numbers.
Let's start with the command center. 27% is explosive growth for dispatch technology. What exactly is happening in 911 centers that is driving this? I mean, a phone rings, a dispatcher answers it. What's changing?
What is happening is a generational technological shift known as a transition to next generation 911. To really understand this, you have to understand how archaic most 911 systems have been for the last few decades.
Oh, I've heard they're basically running on duct tape and Windows 95 in some places.
It's not far off. Historically, a public safety answering point, a PSAP, was basically just a glorified phone bank running on legacy hub and spoke POTS lines.
POTS.
Plain old telephone service, literally copper wires. You call, a dispatcher answers an audio-only line. They look at a really rudimentary computer screen, and they verbally radio a police car. It is disjointed, it's analog, and it's slow.
But Motorola is changing that underlying architecture.
They are completely ripping it up and replacing it with a hybrid cloud solution called Vesta Next. It fundamentally integrates the entire workflow. So when an emergency call comes in now, the dispatcher isn't just getting a panicked voice on the other end of the line.
Hey, kidding.
They are getting rich data. They are getting real-time geolocation of the caller. If the caller is texting 911, it is routed perfectly. The system automatically pulls up video feeds from municipal security cameras near the caller's location.
Wait, really? It automatically pulls the camera feeds?
Yes, and it displays the real-time GPS locations of all nearby officers on a unified map, all on one screen.
So they are essentially turning the dispatcher from a telephone operator into a tactical mission commander with total situational awareness.
Exactly. And on this specific earnings call, management noted that a major driver of this massive 27% growth was several Tier 1 cities, meaning some of the largest major metropolitan areas in the world coming online with these new hybrid subscription models for their computer-aided dispatch or CAD systems.
That's no small feat.
No, the complexity of migrating a major city's 911 infrastructure to the cloud without dropping a single emergency call is immense, but Motorola is executing it flawlessly.
That perfectly explains the command center boom. Now, what about the video segment, up 16%? Because I have to assume, given the margins we're talking about, they aren't just selling more basic closed-circuit security cameras to hang outside a gas station.
Far from it. The video growth is being heavily driven by their advanced cloud-based platform called Alta. And what's really interesting here strategically is the expansion of their customer base. Well, historically, Motorola sold almost exclusively to police departments, fire departments, and maybe some highly regulated critical infrastructure like, nuclear power plants or airports. But with Alta, they are breaking out of the government sector entirely and penetrating entirely new commercial vertical markets.
I noticed this on the call. They specifically highlighted some major enterprise wins.
They did. They highlighted a $10 million fixed video order for a large national U.S. fitness company. They also mentioned a $10 million order for Duke Energy.
Taking military-grade, public safety-tested video security systems with all the AI analytics and cloud storage capabilities and selling them to a national chain of gyms.
It's brilliant.
It is a brilliant pivot, because if you are a corporate security director for a massive enterprise and you see that a system is secure, resilient, and reliable enough for a major city's police force to use for active shooter situations, I mean, you are going to trust it implicitly for your corporate offices or retail locations.
Exactly. It instantly bypasses the usual corporate skepticism. And more importantly, it opens up a massive new total addressable market for Motorola outside of the notoriously slow bureaucratic government procurement cycle.
Right. Selling to a corporate enterprise is much faster than selling to a city council.
Infinitely faster.
It makes a lot of sense. But, we can't just talk about the unbridled optimism. A deep dive requires looking at the risks and the headwinds. Every single hardware company on the planet is currently navigating supply chain turbulence, and Motorola is no exception. Let's dig into the specific pain points management outlined on the call, starting with tariffs.
Yeah, the geopolitical environment regarding trade is incredibly messy right now, and it is hitting their bottom line directly. Management discussed two major cost headwinds: tariffs and memory costs. Let's take tariffs first. The Supreme Court recently ruled against certain IEEPA duties earlier this year, which initially sounded like a big win for importers. However, those duties were almost immediately replaced by new Section 122 tariffs. Management stated very clearly on the call that this specific change will create a $60 million headwind this year, mostly impacting the first half of the year.
$60 million just vanishing into import taxes. That is a brutal external shock to absorb.
It is painful, but it is manageable. The much bigger and arguably more structural issue is the cost of memory.
Right.
The direct cost of semiconductor memory, which is absolutely crucial for virtually everything they make, from their high-def body cameras to their radios to their massive command center data servers, is skyrocketing globally.
By how much?
Well, last year, Motorola spent roughly $50 million on direct memory procurement. This year, they expect that cost to more than double. They're projecting over $100 million in memory costs alone.
Okay, I want to stop right there and really unpack this, because this is where the math gets fascinating. Your memory costs are doubling. That is an unexpected $50 million hit straight to your cost of goods sold. Now, basic economics dictates that if your input costs double, your profit margins shrink.
Naturally.
Yet, we established at the very beginning of this deep dive that their operating margins actually expanded by 50 basis points. How is that mathematically possible?
This brings us to a phrase used by the CFO on the call that every single investor, regardless of what industry they are analyzing, should memorize and look for. The phrase is surgical price adjustments.
Surgical price adjustments. It sounds so precise, like a doctor.
It's elegant corporate speak for our costs went up, so we raised our prices, and our customers paid the higher price without blinking.
But wait, municipal budgets aren't infinite. A city only has so much tax revenue, right? If memory costs keep climbing globally and Motorola keeps surgically adjusting their prices upward, eventually they hit a ceiling where a city council simply votes no on the budget upgrade, right?
Right.
Is there a breaking point?
It's a great theoretical point. I mean, you can't squeeze blood from a stone forever, but you have to understand the dynamic of municipal procurement and what we call pricing power. It is the ultimate test of an economic moat.
Explain that.
Well, in the consumer world, if Apple raises the price of the iPhone by $500, a massive chunk of their customer base will simply defect and buy a cheaper Samsung or Google phone. The switching cost is minor. But in Motorola's world, the demand is incredibly inelastic.
Why wouldn't a police chief facing a budget crunch just go to a cheaper, generic radio vendor if Motorola keeps raising prices?
Because the cost of failure is too high. If you are a police chief and your officers are running into a burning building or a hostage situation, you do not care if the Motorola radio costs 5% more this year than it did last year. You care about one thing. When that officer presses the push-to-talk button, the radio works perfectly, period.
Right. It's life or death.
Exactly. You cannot afford to transition your entire city's communications infrastructure to an unproven, cheaper competitor just to save a few $1,000s on the margins. The switching costs are monumental. You'd have to retrain every dispatcher, every officer, and integrate new software with your legacy 911 databases.
Oh, the training alone would be a nightmare.
Total nightmare. So the friction to change vendors is so high and the risk of failure is so catastrophic that when memory costs double, Motorola just surgically adjusts the price of the end product.
And the municipality just eats it.
They might grumble, they might have to apply for a federal grant to cover the difference, but ultimately they sign the purchase order anyway. It's a captured market driven by necessity. Now, they also mention mitigating some of these costs internally by, accelerating their inventory purchases to lock in current rates and forming deeper strategic partnerships with their semiconductor suppliers. But ultimately, their sheer ability to pass these massive cost increases directly onto the customer without killing their demand, that is the precise reason those margins keep expanding despite the macroeconomic headwinds.
Let's shift our focus to what management is telling Wall Street to expect for the rest of the year. The guidance. And the headline here is unapologetically aggressive. I mean, they are raising the bar across the board.
They really are. They raised their full year revenue guidance by $100 million, bringing the new target to approximately $12.8 billion.
Incredible.
Furthermore, they bumped up their full year earnings per share guidance to a range of $16.87 to $16.99.
A $100 million revenue raise is a massive vote of confidence from management. But what I find truly fascinating is dissecting where that extra $100 million is actually coming from. Because it is not just a general, even distribution of growth across all their business units.
Not at all. It is highly concentrated. And this brings us right back to that acquisition we discussed in the first segment, Sylvus.
Right, the company that was so successful, it triggered the massive $75 million GAAP earnout charge.
Exactly. Of that $100 million total increase in the company's revenue guidance, $75 million of it is driven entirely by Sylvus. Management is now officially projecting Sylvus to generate $750 million in revenue this year alone.
Okay, we need to do a deep dive within this deep dive on Sylvus. What exactly is this technology? Why is a single recent acquisition suddenly generating $750 million and single-handedly driving the entire corporate guidance upward? What do they actually make?
So Sylvus specializes in highly advanced tactical communications. Specifically, they dominate the realm of communications for drones, unmanned systems, and electronic warfare environments.
Heavy stuff.
Very. If we look at the macro geopolitical environment right now, look at the conflicts happening globally, warfare has fundamentally changed. The era of just sending troops with rifles and traditional radios is over. Modern conflict is defined by swarms of drones, autonomous ground vehicles, and unmanned aerial systems.
And all of those drones, no matter how autonomous they are, they need to communicate with a human operator or with each other to coordinate their movements.
Exactly. And the critical challenge is that they need to communicate in hostile environments where the enemy is actively employing electronic warfare to jam their signals.
Right, like spoofing their GPS or blasting static on their frequencies.
Yes. This is where Sylvus comes in. They provide what they call spectrum-dominant software. They create highly resilient, self-healing mesh networks.
Let's explain how a mesh network actually functions under active jamming, because this is the core of their value proposition.
Okay, so in a traditional radio network, a hub-and-spoke model, if the main cell tower or the central command antenna goes down or gets jammed by an enemy frequency, everyone's radio dies. The whole network collapses.
That is blind and deaf.
Exactly. But a mesh network turns every single radio, every single drone on the battlefield into its own mini cell tower.
Oh, wow.
Yeah. If an enemy successfully jams drone A, the network doesn't die. Drone B's software instantly senses the frequency interference, recalculates the path of least resistance in milliseconds, and bounces the data signal to drone C, which relays it back to command.
That's incredible.
It essentially acts as a living, breathing, organic network that routes around damage. It provides incredibly secure, high-bandwidth, broadband connectivity at the very edge of the tactical battlefield.
It is essentially an unkillable network. And considering the shift in global defense strategies, the military demand for this capability must be absolutely off the charts.
It is unprecedented. The CEO, Greg Brown, noted on the call that they're seeing massive international and defense demand, not just from the U.S. Department of Defense, but from allied agencies worldwide.
Do they have specific examples?
Yeah. As a specific example, they highlighted a massive $78 million order from an unmanned systems provider in Germany. They also just launched a highly anticipated new product called the Streamcaster 5200.
I saw the launch of the Streamcaster 5200. Now, in defense tech, usually if you add advanced sensing capabilities to a radio, you end up with a massive battery drain or a significantly heavier unit, right?
Yeah.
How did they pack spectrum sensing into a mobile ad hoc radio without sacrificing portability?
That is the engineering marvel of it. In defense tech, everything revolves around the acronym SWAP: size, weight, and power.
SWAP. Got it.
The ultimate goal is always to make the technology smaller, lighter, and more power efficient without sacrificing a drop of capability. The Streamcaster 5200 nails the SWAP equation perfectly. It is their smallest, full-featured mobile ad hoc network radio ever built. And yet, it includes advanced spectrum sensing capability.
Meaning it can actively detect if the enemy is trying to jam it.
Yes, or it can simply detect any enemy radio frequencies emitting in the general vicinity. This gives the warfighter on the ground incredible situational awareness of the invisible electromagnetic spectrum around them. They can basically see the enemy's electronic footprint.
That is a massive tactical advantage.
Huge. It is highly advanced, incredibly specialized technology, and the financial margins on it reflect that specialization. The EBITDA margins, earnings before interest, taxes, depreciation, and amortization for Sylvus are running at an astronomical 45%.
45% margins.
Yeah.
No wonder they were absolutely thrilled to take the $75 million non-cash charge for the earnout. They essentially bought a money printing machine that is inextricably tied to the fastest growing sector of global defense spending right now.
Precisely. It was a masterstroke acquisition.
Yeah.
And to support that explosive growth, Motorola is already rapidly increasing their supply capacity at their California facilities, and they announced plans for a new geo-redundant manufacturing site to come online in 2027.
They are actively pouring fuel on this fire to ensure they can meet the global demand.
Exactly.
So with Sylvus driving massive top-line growth, let's look at the broader profitability outlook and how management plans to use all this cash. Because despite the memory costs doubling, they made a very bold claim regarding their margins for the rest of the year.
Yes, they reaffirmed their guidance that they expect a full 100 basis point expansion in operating margins for the full year.
A full 1% expansion, despite every macroeconomic headwind throwing everything it has at them.
Right. And regarding cash flow, they are projecting an incredible $3 billion in operating cash flow for the year.
$3 billion in pure cash generated from daily operations.
Right.
What does a company actually do with that much capital?
You allocate it strategically to maximize shareholder value. The CFO outlined their general capital allocation philosophy quite clearly. About 60% goes to share repurchases, 30% goes to paying dividends, and the remaining 10% is dedicated to internal capital expenditures.
So buying back their own stock.
Heavily. This quarter alone, they bought back $118 million in shares. This is crucial for retail investors because every time the company buys back and retires a share, your remaining slice of the ownership pie gets slightly bigger, mathematically increasing the value of your position.
Even if the company doesn't grow at all.
Exactly.
Uh-huh.
But beyond the standard buybacks, they use that massive cash flow to fund strategic M&A.
Which brings us to the other major announcement on the call, the impending acquisition of Bell Canada's LMR network. Now, I want to really unpack this. What exactly is an LMR network, and why is a software and AI-focused company buying physical network infrastructure in 2026? It feels backwards.
I know, it sounds like buying a telegraph line, right? But LMR stands for Land Mobile Radio. It is the core foundational legacy technology of all public safety communications.
Okay.
When a police officer presses the button on the radio, it doesn't run on the local Verizon 5G cell network. It runs on an LMR network. It consists of the physical radio towers, the antennas, the trenching, the base stations, and the dedicated frequency spectrum that allows those secure radios to operate across vast geographic areas.
Got it.
Bell Canada has been operating a massive, highly robust LMR network, providing mission-critical dispatch services to public safety agencies all across Canada.
And Motorola is buying that entire business unit from Bell Canada. The transaction is expected to close in the fourth quarter. It immediately brings in approximately $100 million of recurring managed services revenue.
Right.
But the brilliance of buying this LMR network isn't just the $100 million in revenue. There is a massive physical moat here.
This is the absolute aha moment of the strategy.
The value isn't just the software contracts. It's the physical trenching and the municipal tower permits.
Yes.
If a competitor wants to offer radio services to the Canadian Mounted Police, they would theoretically have to build their own network. But no competitor is going to get the zoning approval from local governments to build a duplicate set of massive radio towers across the entire geography of Canada. It is physically and legally impossible.
No one is doing that.
By owning the physical copper, steel, and permits, Motorola essentially becomes an unavoidable toll booth for public safety communications in that entire region. It is a textbook example of regulatory and physical capture.
That is exactly right. It establishes an impenetrable physical moat. It gives them a massive captive audience of customers that they can now cross-sell their modern software to.
Oh, the cross-selling.
Huge. Once Motorola officially owns the network, they can go to every single Canadian police department using it and say, hey, we are running your radio network now. Wouldn't you like to upgrade your officers to our new AI-powered body cameras, which integrates seamlessly with the tower infrastructure we now control?
It is a brilliantly synergistic use of their cash flow to lock down an entire national market.
It really is.
Which perfectly transitions us to distilling all of this data, all of these acronyms, and all of these strategies into actionable takeaways. Looking at the totality of this earnings call, the record-breaking revenue, the staggering $15.7 billion backlog, the consistent margin expansion, the explosive margin-rich growth of Sylvus, and the strategic capture of the Bell Canada network, we have to take an opinionated stance on the health of this company.
And the stance, based strictly on the financial data and the operational execution discussed on the call, is unequivocal. This was a highly, undeniably bullish quarter.
Bullish with a capital B.
Absolutely. There is very little, if anything, to critique in these numbers. The management team is executing at an exceptionally high level across multiple, highly complex technological disciplines.
So what does this mean for the person listening right now?
It means you need to fundamentally reframe how you think about Motorola Solutions. You need to forget the flip phones entirely. This is what I call a defensive stock playing offense.
I love that framework. Let's break that down. A defensive stock playing offense.
A defensive stock is traditionally one that holds its value, or at least doesn't collapse, during an economic downturn. Think of utilities, healthcare providers, or consumer staples.
Right, because people always need to pay for electricity. They always need basic medicine, and they always buy toothpaste, regardless of what the stock market is doing.
Exactly. Motorola is deeply defensive because public safety is the ultimate non-discretionary budget item. A city government cannot choose to just turn off its 911 dispatch center because municipal tax revenues are down for the quarter.
They'd be sued out of existence.
They are legally and morally obligated to pay for the radios, the dispatch software, and the maintenance contracts. That $15.7 billion backlog represents government-funded, contractually locked-in revenue. That is the defensive bedrock of the company.
And the offensive part of the equation.
The offensive part is how aggressively they are capturing entirely new markets and relentlessly pushing the technological envelope. They aren't just resting on their laurels, sitting back and collecting maintenance fees on old radios.
Right.
They're aggressively buying companies like Sylvus to dominate the rapidly expanding drone warfare and electronic warfare space. They are expanding into corporate and retail security with their Alta Cloud video platform. They are actively playing offense by expanding their total addressable market far beyond traditional public safety.
Let's give some specific, actionable advice based on that. Let's say you are a listener who already holds MSI in your portfolio. What is your move?
If you are already holding, you sleep very well at night. The foundation of the business is rock solid. The consistent 50 basis point margin expansion proves that management is controlling costs effectively, even in an inflationary environment.
Yeah.
The aggressive share buybacks mean your individual slice of the pie is getting marginally bigger and more valuable every single quarter without you doing a thing. You hold this stock as a cornerstone of stability in your portfolio, knowing it also offers significant double-digit growth potential in its software and defense segments.
But what if you don't own it? What if you are listening to this, you were convinced by the pivot, but you were considering buying in today? A very common hesitation with a stock that has had a strong run and is posting record numbers is, did I miss the boat? Is the valuation too stretched to buy in now?
Valuation and entry points are always valid considerations, but you have to look at the structural quality of the asset you are buying. You are buying into a company with an almost impenetrable economic moat. The switching costs for their municipal and defense customers are astronomically high.
So high.
You are buying incredible proven pricing power, the demonstrated ability to pass on doubling memory costs without losing a single customer.
And crucially, you are buying a company that is successfully modernizing an industry that desperately, desperately needs it. Let's talk about their artificial intelligence integration, because frankly, this was my absolute favorite example from the entire earnings call.
Oh, it's so good.
It proves beyond a shadow of a doubt that their AI strategy isn't just a marketing buzzword slapped onto a PowerPoint presentation for Wall Street analysts. It is actively solving actual, physical, excruciating pain points for police officers every single day.
You're referring to the rollout of the new SVX body cams and their proprietary AI redaction software.
Yes. The SVX is their new body-worn assistant. It is a massive leap forward. It is not just a dumb camera recording video. It is deeply integrated with the officer's smart radio and their earpiece.
Right.
So it captures not just what the camera visually sees, but exactly what the officer is hearing over the radio network in real time, perfectly synced. But the real magic, the true return on investment, happens after the shift ends.
In the digital evidence management ecosystem.
That's exactly. Historically, if a police department had an incident and they were legally required to release a body cam video to the public, the press, or the courts, someone, usually an officer on desk duty or a highly paid administrator, had to sit in front of a computer and manually, frame by frame, blur out the faces of innocent bystanders.
Blur out license plates.
Mute sensitive information like home addresses. It is incredibly tedious, soul-crushing work. On the call, management noted that their new AI-assisted computer vision redaction software can take a complex video job that previously required 35 hours of manual human labor.
Which is basically a full work week.
Right. And autonomously cut it down to 1 single hour.
35 hours of labor reduced to 1 hour. The efficiency gain is staggering.
Think about the massive return on investment for a budget-constrained police precinct. You are freeing up nearly an entire week of administrative time for a single Freedom of Information Act video request.
It's massive.
They also highlighted an 800% increase in the adoption of their Narrative Assist AI tool. The AI utilizes natural language processing to listen to the audio from the SVX body cam, transcribes it perfectly, and actually auto-generates the initial legally formatted draft of the police report for the officer.
It is entirely revolutionary for the daily workflow of law enforcement. And this is precisely why these agencies are adopting the high-margin software so rapidly. The total cost of ownership for the municipality actually goes down when you factor in the massive quantifiable savings in administrative labor and overtime pay. This is the ultimate expression of the moat we have been discussing. Once a police department gets used to artificial intelligence, auto-generating their reports and redacting their public videos in an hour, they are never, ever going back to a competitor who just sells a basic disconnected camera. The software lock-in is absolute.
It is a phenomenal, undeniable value proposition. Which brings us to our final thought for you to chew on as we wrap up this deep dive. Because as incredibly bullish as this quarter was, as strong as the backlog and the margins are, no giant in the technology sector is completely invulnerable. The landscape changes quickly.
There is always competition. The moment you become a monopoly, you put a target on your back.
Always. And during the Q&A portion of the earnings call, an analyst directly brought up a major competitor, Axon. Now, to set the stage, Motorola currently commands a massive, dominant market share, estimated at over 60% in the roughly 6,911 public safety answering points, or PSPs, across the country. They are the undisputed king of the 911 call center infrastructure.
But Axon, who the general public famously knows as the creator of the Pazer and the dominant player in the standalone body camera market, is starting to make very aggressive strategic moves upward.
Right. Axon has recently made a series of aggressive acquisitions specifically designed to build out their own cloud dispatch software and enter the 911 call center space. They are actively trying to encroach on Motorola's most profitable home turf.
Oh, they want that software revenue.
Badly. Now, Motorola CEO Greg Brown was asked about this directly, and he was supremely confident on the call. He pointed to Motorola's advanced hybrid cloud capabilities with Vesta. Next, the deep, seamless integration of their AI assist tools across the entire hardware-to-software workflow and their decades-long relationships with these municipalities. He essentially told Wall Street, "We are very aware of them, but we love the hand we are holding."
And objectively, they should love their hand. A 60% entrenched market share in a sector where the switching costs are monumental is a literal fortress.
It is a fortress. But the profound question you have to ask yourself as an investor trying to look not just at next quarter, but 5 to 10 years down the road is this. Will Motorola's sticky, deeply integrated, physically entrenched ecosystem be enough to fend off an incredibly aggressive, well-funded, software-native competitor like Axon?
It's a great question.
Because technology moves incredibly fast. AI disruption is not just a buzzword. It is a reality that can upend decades of dominance in months. Can the legacy giant, no matter how well they have pivoted, keep moving fast enough to protect the castle from a nimble invader?
It is the ultimate defining question for any dominant market leader in the modern era. Innovation doesn't sleep.
We started this deep dive talking about flip phones, about how easily and how permanently a company's image can get stuck in the past while the physical reality of the company races into the future. Motorola Solutions has, by all financial metrics, brilliantly navigated the perilous transition from a consumer hardware purveyor to an indispensable AI and defense powerhouse.
Truly an amazing pivot.
But in the ruthless world of enterprise technology, the exact moment you stop evolving is the exact moment you become nothing more than a nostalgic memory.
The massive numbers reported today dictate that they are evolving faster and more profitably than ever. But the horizon of competition is always moving.
And we will be right here to track every single movement. Thank you for joining us on this deep dive into Motorola Solutions. Keep looking past the headlines, keep asking the hard questions about the companies you own, and we will catch you on the next one.